Welcome back to the Contrarian, everyone. It's my pleasure to introduce David Hunter for the fourth time now. He has over 50 years of experience under his belt when it comes to both the sell side and buy side on Wall Street, also managing money very successfully. He's retired now, but still offers a letter Contrarian Value Advisor by paid subscription. He's also very active on Twitter at Dave H. Contrarian. Very much so look forward to hearing his thoughts today on the recent state of the markets and everything with Japan and the yen going on. So, David, thank you so much for coming on again today.
Oh, hi, Logan. It's great to see you. Thanks for having me.
Yeah, so David, I'd really love to hear your thoughts on where we are in your Meltup thesis. Has the recent, news and price action surrounding the yen carry trade and everything, resulting from that, the, dramatic and very quick sell-off in the U.S. equity markets, how has that impacted your Meltup thesis, if at all? What we expect, in the coming weeks with everything in the markets with what has transpired in the last couple of weeks.
Yeah, it actually hasn't affected my forecast at all. It might surprise people, but it's actually reinforced the forecast. I know that's not a popular view out there. We've seen sentiment turn very bearish in a hurry. It's not so surprising given, as I've said on Twitter, we've had from October of 2022 an 80, almost 85% move up in the Nasdaq and a 62% move up in the S&P from those lows back at the bottom of the at the top bottom of the bear market and beginning of the bull market. So they have such a long run, and with a few setbacks along the way. We've had corrections along the way, but I think people got accustomed to kind of seeing it go up every day, and so when it goes back down 1% or 2 or 3, I would see people get a little bit nervous. But then when it goes down, 7 or 8% in the S&P and 10% in the Nasdaq or more, it's they get really shaken up. So we've seen, as I like to say, we've seen a rebuilding of the wall of worry, and quite a nice rebuilding. So I think sentiment is quite bearish right now. Amazingly, again, we're not that far off of highs, but two things happen. One, the market obviously moved down very fast, particularly from last Thursday through Monday. And secondly, the Fed didn't cut rates on Wednesday. It wasn't a big surprise that they didn't. They hadn't telegraphed that they would, so that was kind of not unexpected. But then to have Friday a jobs number that was surprisingly negative compared to expectations, it just set off the animal spirits, and people just started thinking, oh my God, we're in recession already. We're heading for a hard landing. The Fed's blowing it. I mean, you just saw all kinds of things. And instead of stopping and realizing a quarter point cut in rates is not going to change the economy at all. Whether they did it or didn't isn't a big deal. It's pretty clear they're going to do a cut in September, and after what's just happened, it wouldn't be surprising if it's a half point instead of a quarter. And more importantly, as I have said so many times, the Fed doesn't really set rates. It's the bond market that sets rates. So, we had 3 months ago, everybody talking about 5% again on the 10-year. It was at 4.7, above 470, and they were extrapolating out and saying it's going to 5, it's going to 6, and it stopped there, and it's down 100 basis points from there in 3 months. That's a cut in rates. To worry about a quarter point cut from the Fed when you had a 100 basis point cut from the bond market, and the 10-year is a much more important factor in the economy. The Fed controls the overnight bank lending rate, so the banks square up with each other, lend each other money when they need to. Some banks have excess fund reserves, others don't have enough, and so that's the rate that the Fed controls. That's overnight rate. tenure is what's used to determine loan rates, mortgage rates, etc. So it's rather surprising that people don't pay more attention to bond rates and pay all their attention to the Fed. But that's unfortunately the nature of things. So that narrative was out there that, oh my God, the Fed's blown it. We're about to head into a hard landing instead of a soft landing, and it's the stock market's peaked, and down we went. And then to on top of that, you got the yen, which has been straight down for a couple of years, finally turned. The Bank of Japan announced that they were going to hike rates for the first time in a long time, a quarter point. I think it was a quarter. And again, the narrative went crazy. It was like, here we go. Um, the yen's going through the roof, and the Japan's going to face ever higher rates, and everything's going to crash. But more importantly, with the yen rising by that much in just a couple days, a lot of particularly hedge funds had borrowed in Japan because it was basically 0% borrowing rate, and then invested elsewhere. So they may have invested in Japan too, but they also invested over here in all sorts of things, whatever they thought was a good investment, a good trade. When the yen went up, it really meant that cost of carry, that cost of borrowing went up a lot for them. And so they had to quickly reverse themselves, reverse their trades, get out of that borrowed money, pay back that borrowed money and sell their assets. So across the board on Monday, it started on Friday, but across the board on Monday, you saw this, particularly in the morning, this deep sell-off. And it was because of a reversal in that carry trade. And that's how hedge funds operate. I mean, it's, things move fast. And so I think we saw the lows for this correction Monday morning when you got that. You've had a bounce this, last 2 or 3 days in the market. And the kind of conventional wisdom is that you were going to bounce because it got oversold, it went down fast. You were going to bounce, have a couple day rally or a few day rally, and then go to much lower lows. So you hear calls of 5,000, 4,800, 4,900 on the S&P, and some saying it's going a lot lower than that the top is in, etc. My guess is the lows for that correction are in, and that it'll take a little time here, but I think we're going to be off to the races again. We'll see new highs, if not this month, next month, probably this month though, and probably be. I think this may be the parabolic leg that takes us to the top. So my targets haven't changed. Well, maybe some have since we've talked. I raised my target on the S&P back in January to 7,000, and that's still my target for the S&P. My target for the Nasdaq was 20. I'd raised it to 23,000 back in January. I raised it in my most recent market letter in July to 24,000, and have a target of 55,000 for the Dow and a target of 3,300 for the Russell 2000. So those targets are all intact for me. I haven't changed a bit. As I said, this wall of worry that's been built just reinforces, I think, that we have a big, further run to go on the upside. I believe it's the top of a 42-year secular bull market that started in August of 1982. So I think this is a major top, biggest top in my lifetime, and that what will follow will be a big bear market and a very hard landing in the global economy.
Okay. Yeah, that's very helpful just to hear, your thoughts on the current, state of the market. So it feels like a lot has happened in a short period of time, at least with the narrative out there. There were a lot of people maybe who were pessimistic before who kind of got on board, it seemed, and then in the last couple of weeks they definitely turned bearish again. And it sounds like from here to the top, it could happen pretty quickly from what you're saying. It could be a pretty quick run from here to the top, even though it seems like we're a ways from your targets, obviously. Um, but just is that mainly with how psychology, kind of how we saw it flip very quickly to being bearish, can very quickly flip the other way, and then all of a sudden everyone realizes they need to get back in? Is that what's mainly driving it to these extreme blow off top type moves?
Yeah,
Or
to a degree, that's part of it. Certainly, you have people acting on their sentiment, so acting on their beliefs. So as this thing rolled over hard, and more people jumped to the bear side, the more aggressive traders are shorting this thing, saying, "Oh, if this is the top, there's a long way down." And so you got people short, hedge funds or whoever, um, and you've got other people who, like you said, didn't really believe the rally anyway. They were kind of caught into it because of the momentum. They fought it all the way from October 2022, and then when it went to new highs, they might have started to get on board, but they were still saying, I don't know if it has legs. And then when all of a sudden it went from 4,800 to 5,600, it was like, oh, I'm missing something. I got to get on board. But they were talking in generalities. It's not everybody, obviously, but a broad group of investors were in, but they were in they were in there, but nervously in there, or in there without conviction. They were in there because the tape was going up and they were playing the momentum. As soon as that momentum disappeared, so did they. So yeah, I think like I said, you built the wall of worry. The sentiment is back to a level that really is um, more typical of a bottom, not a major bottom, but a bottom. And that is, it's hard for people to understand that from a contrarian standpoint, but that is future fuel. If you've acted on your beliefs, you've gotten out of the market, or you've lightened positions, or you've gotten more defensive. When this thing reverses again, and it uh, moves towards new highs again, they're going to say, "Oh, this thing does have legs. I've got to get on." And as well as you're going to have short covering, etc. So I've made the case throughout my call here, from the bottom, that the last leg would be the steepest leg we've seen. That it would go parabolic. Parabolic means rather vertical. So you cover a lot of ground in a short time. Do I know that you can cover, like you say, a very big move from where we are now, 5,300 to 7,000 in 3 months? No, I don't know that. Can it happen in 3 months? Yes. Will it take 4 or 5 months? Possibly. I don't, the point is it's going to be the steepest leg yet, which is pretty quick, and covering a lot of ground. So if in fact this is that final leg, that's what I expect to see the balance of this month, September, October, probably. I'm using the time frame as a, just a guess that it's kind of between now and the election. You're going to see most of the ground covered, if not all of it. Possibly it goes beyond that. I don't want people thinking that I have some crystal ball that can say, precisely when it's going to end, because I don't. But I think it's going to be steep. I think it's going to be um, you're going to see a lot of stocks. It's going to be steep and broad, so you're going to see it play out in a lot of stocks, not just a few.
okay, so we'll kind of see a broadening again of the market, kind of like where it seemed to be going prior to this sharp correction we had, with some small caps finally playing catch up and everything like that coming into play. I'm curious to hear your thoughts with, there's the election in November and other things like that. Is there anything that you would say would derail the melt up or make it look differently than what you have just laid out with it being very, potentially a very parabolic type of final move. Could it be more drawn out if there's more social unrest or anything like that? Or yeah,
Yeah.
do you think much about that even?
Yeah. Before I answer that, I just want to kind of fill out the. I don't want to skate over the Russell, because I really believe that's a huge move. If we go from where we are now to 3,300, you're talking about a huge move in a similar time frame to the S&P. So it had that run. It was up 10% in that quick week where everybody was bearish on the Russell and saying, I heard it over and over. Why are you calling for a big run in the Russell? It looks terrible. It's not performing. It's the Russell. Small caps aren't going anywhere. I heard that over and over, and then all of a sudden, because you had gotten to that level of sentiment, it busted out and had a big vertical move um, in a week. And what we've done is given most of that back in this last week's sell-off. So the same people who got kind of excited with a 10% run in the Russell are right back on the bear side, or skeptical and saying, well, I guess that was just a false breakout. But I do think what we did, the Russell's come back to the 200-day moving average. It's done really no damage. It just kind of filled in from that huge run. It was a huge few-day run. I think I'm very comfortable with my 3,300, which is a huge move from here. I do think when I say it's going to be broader, it's going to be a lot broader. It's not the Magnificent Seven, although the techs will play. I have a target on. I don't want to jump ahead of you, but I have a target on SMH, the semiconductor ETF of 400 now. So it got down to basically 200. It's a double. And if it happens in a double in 3, 4, 5 months, is an unbelievable move. And a lot of people are saying the semi moves over, or semis are gonna they had their day. I don't think so. So this is going to be both the leadership that kind of got us here, and then the new leadership of small caps and cyclicals. And like I said, it's going to be, I think, unusually. Everybody was pointing to the narrow market. Now we're going to see that the market is actually broadening into a top. More typical would be a narrowing into a top. But I think what's going to run here, the narratives are going to get you there, is going to be, yes, the tightening cycle is over. The Fed is easing. That the fear of a hard landing was premature. That we're having a soft landing, and that basically the Fed's going to engineer a new, a liftoff into a new cycle, basically, or it'll feel like a new cycle in terms of a lot of the early cycle things that have been out of favor are going to play again. Cyclicals, etc. So you're going to have kind of the old stuff still playing and new stuff getting on board. Now, to get to your question, yeah, there's always something that I can always be wrong. I speak with conviction because that's what my work gives me when I see what I see, and if I have conviction, I'm going to speak with it. But that doesn't mean that I'm going to be right, or that I know this is going to happen, because I don't. So can something come in here, so-called black swan, or something come in here to disrupt things, election-wise, or just like we saw with the carry trade, but much bigger? Could we have an event geopolitically, World War III, or a huge Middle East blow up with Iran entering the fray and us having to go in there? Could any of that happen? Certainly, it's there's always a possibility of something like that. I will say, typically, if history is a guide, oftentimes wars are the beginning of upside, not the end of a market. So I learned that a hard lesson back in the early 1990s, when we had Gulf War I. When we entered Iraq, and took defend Kuwait, um, I thought, oh, this is going to give us a buying opportunity down the road. We're going to get hit here. And you had a couple of days where it was, volatile to the downside, if I recall right, and then it was off to the races. So I think people have to be careful. Don't just assume. Obviously, a world war is a different story, but don't just assume that when there's geopolitical tensions around the world and that look like they're going to escalate, that's necessarily going to turn the market lower. It doesn't necessarily. But are there things that could crop up? Yeah, but I will tell you, of the things I can analyze and the things that I see in the market right now, there's nothing that I see to suggest a bear market. What I see is very bullish. And I do, as I say, I use fundamentals, I use technicals, I use obviously I think my macro is as good as anybody. I use my macro analysis. I use sentiment. I'm a contrarian for sure, and then I use cross market analysis, and which really helps give me the conviction when I see those things underneath the surface that are confirming what I see in the averages. And right now, I just see a lot of bullish things. Now, I don't know what's going to happen the next day or next week, but this is, it's not a long time out. I'm not saying, I get accused of being a broken clock because the cycle extends, but I'm not saying it's going to take 2 years or that I don't, it could be 3 months or 2 years. No, I'm saying, it's 3, 4, 5 months is what I would expect. Could something come in like the pandemic did to stretch it out? Sure. But right now, all my analysis points to this being a parabolic coming up, and that will, I think it'll be the biggest rally we've seen in our lifetimes.
Yeah, and from what you're laying out, it sounds like the Fed's actions don't play into it very much. I mean, you were saying maybe they cut half a point in September, but as you pointed out, the bond market has already brought rates down quite a bit on its own without the Fed doing anything. But then you also mentioned how the Fed may kind of trigger the bust at the top when they see the markets, at these extreme highs. They may think that they need to tighten. I'm curious to hear, does the Fed's actions play in at all with the melt up and then the bust, or is that kind of just noise that the news media likes to pay attention to? Or
Yeah, no, I don't mean to suggest that the Fed isn't a key player in everything. It is. The whole reason we had the 2022 bear market was because of Fed tightening. Most of the reason anyway. And they hiked rates 75 basis points, 3 meetings in a row, I think, if I recall, and maybe more. And they started unwinding some of the QE, the QT. They started unwinding some of the balance sheet. So for sure, the Fed matters a lot to markets. I don't mean to suggest they don't, but they don't matter in the way people like to read it, like, oh, a quarter point cut is going to save the system, or not doing a quarter point cut is going to lead to the end of the bull market. It's not that. It's more what my letters, I talk about this a lot in my letters. I believe the Fed is behind the curve. I believe the Fed, by using, by definition, backward looking data to determine what forward-looking policy will be, you're almost by definition behind the curve. And I think we're at that inflection point. That people were right to be a little nervous about the Fed not doing something last Wednesday. They should have cut, no question. They should have cut. I believe you are seeing the beginnings of, as I've said, you may even be in recession now. When we go back, the National Bureau of Economic Research is responsible for dating recessions. They do it after the fact. When they go back after we're out of recession and look back, I will not be surprised if they are able, their work dates the recession to, let's say, June or July of this year. So we may already be in recession. We may not be, but we may be. Certainly, sectors of the economy are in recession. You know, parts of the consumer, the lower end of the consumer population are in recession or are feeling like they're in recession. So, um, but yes, the Fed is important, but from a not from a meeting to meeting quarter point cut standpoint, more from a the thing the quarter point cut would have done maybe, and it probably wouldn't have headed off a correction, might have softened the degree of the correction, but um, it sends a signal that the Fed is at least beginning to get on board to the fact that they need to ease. The fact that they're trying, I think they're still fighting the last war, which is, um, you know, we waited too long to react to the inflation and we got criticized for it. Now we want to make sure we don't reignite inflation. That, I get the sentiment, but I think they're overlooking, as they say, they have dual mandate and they're using jobs as their other measure of, one's the economy, one's inflation. Unfortunately, jobs are a lagging indicator. So if you're using, a monthly jobs number or even the weekly numbers, if you're using all the, jobs data to determine when to time, you're even farther behind the curve because it's a lagging indicator. It's not even a coincident indicator. I think the stock market is probably your best leading indicator, and they don't want to use that at all. Unlike other Feds, I mean, the problem we have with Feds in general, but this one in particular, I don't know that there's anybody on that Fed, in fact, on the FOMC committee. In fact, I'm pretty sure there isn't, with market experience. There's nobody that understands markets in terms of their ability to forecast the future. Now, of course, the markets lots of times misjudge things and they forecast something that doesn't happen. So that I'm saying it's a perfect indicator, but in the aggregate, markets, both bond and stock, are leading indicators of what's to come. Bond market's a better forecaster than any member of the FOMC. I guarantee you that, because it's a law of large numbers. You've got a lot of people acting on what they see and what they believe, and taking that large number and discounting it into a market is you got a much better chance of that being a pretty good predictor of what's coming. So the fact that the bond markets dropped rates 100 basis points is telling you that when they look at all their work, and everybody does it differently, but when they look at all their work, when economists look at it, when market participants look at it, informed participants, they're coming to the conclusion that inflation's lower and heading lower, is down and heading lower, and and they're also probably this last 100 basis point move has as much to do with they're seeing all the early signs of an economy that's decelerating and soon to decelerate faster. The Fed unfortunately isn't there yet. They're beginning to get there. They understand the economy's decelerating. I don't think they understand the degree to it, and that's being weighed against. Gee, we don't want to make a mistake again and be, and let inflation break out. So all those things play into a committee. And again, committees can see camels out of horses, or whatever, predict camels out of horses. So, committees, particularly committees that are designed to be consensus, can be slow to react and more careful and all of that. So this isn't new. We've seen this every cycle. The Fed is usually behind the curve and then has to rush to catch up. I don't know that this is, I can't say this is absolute. I'm not counting on it to get the Meltup. A lot of other things are pointing to the Meltup, but I wouldn't be surprised if between now and the election, or now and the end of the year, the Fed's in catch-up mode. And that once they're in catch-up mode, that's a wind at your back as an investor. That will drive the market. So, by the time we get to September, And I'm presuming they're not going to cut before September. They could if things worsen. They can act, and they will. But right now, I'm presuming they'll wait until September. That we won't see one until September. Like I said, instead of a quarter, it might be a half. Or if it's really some things starting to really accelerate to the downside, you might even see that 3/4. I don't predict that. I'm not expecting that. But I'm just saying those are all possibilities, even if they're remote possibilities. But then you might then see another cut the next month, or certainly early November when they meet again, and another cut. And the cuts may get bigger if they're behind the curve and they start recognizing they're behind the curve. They're not going to be doing quarter point cuts. So all of that may play in. I have no idea, but what I can have a pretty good idea on is that the bond market will be ahead of them. So if we got down to, I think we got down to 370, maybe even the 360s this past week, and now we've backed up to 4% on the 10-year. I'm predicting we'll see 2.5 during the Meltup. So between now and let's say the election, I think you probably will see 2.5. So it doesn't really matter what the Fed, what rate the Fed chooses to move to. It'll be an add-on if they get more aggressive, but it doesn't matter that much.
Okay, that's very helpful for just laying us, how that works and laying that out for us. And it sounds like from what you're saying, we may already be in a recession, but you still see a lot of upside ahead. Just is that because of how delayed all the data is and how delayed it is for people to recognize that we're in a recession already, when in fact they might interpret it as just being very bullish, with inflation not being a concern anymore?
Yeah, because as you're seeing now, I mean, you're getting ebbs and flows in the data. So just when everybody decides, oh, hard landing's coming, the numbers are all going to start accelerating to the downside. The ISM number this week came out surprisingly positive, better than expected, and above 50. So the economy, just like the market, goes up and down and doesn't go in a straight line. So you may be in a recession, and yet you may get data that kind of goes around that zero mark for a while, or even if the numbers, let's say below 50 on an ISM is negative. I'm just using not just a generic, but let's say you had a 46 reading on something and it went to 48. It's still below 50, which indicates recession, but the street will treat it as, oh, that's improvement. So you can have, until we really get into where everybody knows we're in recession, you can have data kind of play around in that soft landing scenario for a while. And I think that's probably what we'll see. Plus, don't forget, when rates come down, you get some offset. So let's say, a month ago, before rates, a month or two ago, before rates started coming down, housing was really coming to a stop. You started seeing inventory was building in certain areas of the country pretty fast. And, people looking to buy were dropping off because they couldn't afford a 7+% mortgage rate. Now all of a sudden, if the mortgage rates dropped over 100 basis points, now all of a sudden some people that were on the sidelines are coming back in. So you can have a bounce in housing, or better than expected housing numbers for a couple months, even though the trend is down. I think we've made the peak in housing, in my opinion. But that doesn't mean you can't have bounces, because so many people are driven by the mortgage rate. So and same thing with car sales. Car sales may have looked like they're drying up, but you might see, as rates come down here, if you got car loan rates coming down, you may see activity pick up for a couple months, and it just kind of so. And during that time, what we won't see, I don't think, is the market nosedive. I mean, the economy nosedive and a parabolic. So, I think you're going to have some bouncing around, whether you're in recession or soft landing, whether, as I've said for a while, I think the most likely narrative, I keep predicting the narrative, the most likely narrative for the last parabolic run is soft landing, but inflation having been beaten, more signs that we're going to the 2% mark or below on inflation. It allows people to have their cake and eat it too. They've got, and allows the Fed to have that. So they can be cutting because inflation's acting much better, not cutting because they think the economy is about to crater, right? If they think if the cutting is happening because the economy is cratering, then it's a harder call for the market because you've got to deal with the earnings side as well as the fact that the interest rates are coming down and multiples are going up. So I think more likely it's going to be bouncing around the flat line um, for a few more months, and some good numbers as well as bad. Some numbers coming in better, some worse. Employment might start softening, but that gives investors more cheer because they think that means the Fed's going to be more incentivized to cut. So you get all of that and kind of put it into the mixer, and it comes out, in my opinion, almost like the Goldilocks scenario for the market. And
Okay.
don't forget, if we have finished what has been a 2.5 year tightening cycle, and you're beginning a new easing cycle, it allows it, not everybody, but a lot of the big shops don't look at the next quarter or the next 2 quarters. They're looking out over the horizon and they're saying, particularly the quants, we can start boosting our numbers in 25 and 26 and 27 because a new cycle is starting. The Fed does determine cycles in terms of their easing and tightening. So if we're beginning a long new cycle, where they beat inflation, where it's time to turn the corner and go back to an easing cycle, those usually last for a while. Now, in my bust forecast, um, I think we have something in between, where they're behind the curve and they don't ease fast enough, and we pay the price. But for lots of shops and for lots of investors, they're going to be able to start extrapolating out earnings at much higher numbers. And again, too many people think markets are about today and tomorrow. Markets are about earnings out 6, 9, 12, 18 months. It's you're building in things based on longer term numbers, and for quants, you're also discounting out way beyond that in terms of a cash flow, steady stream of cash flow. So it can matter whether the Fed's on board or not.
Okay. Yeah, thank you so much for laying out what you think the likely narrative is behind the Meltup, because that's helpful to think about as well. And one other market I guess we haven't talked about is the gold, silver, and precious metals miners markets. And these have very much so frustrated investors in the last few years, I think, because it was anticipated that with high inflation and looking at prior time periods and maybe in the 1970s when that was also occurring, gold ripped higher, and then it seemed to be frustrating people for a while. And we have seen gold and silver, the metals, finally rally pretty significantly and then sell off in the last couple of weeks. But you also have some pretty aggressive targets on the metals and miners, and it seems like a lot of people tend to think that gold and silver should be inverse with what the stock market is, where it's headed. But it sounds like you're seeing a dual rally going on with both the stock market and precious metals at the same time. Is this just more participation along with this narrative that you see spilling into gold and silver?
Um, yeah, you're right. I do have aggressive numbers. By the way, I've raised my target for silver from 60 to 75. I did it in 2 steps, I guess. I went from 60, which I had as a long time target. Then I went to 60 with a range of 60 to 75 if all went right. And in my last letter, I raised it 75. So seems crazy. 60 seemed crazy to people. Um, I think it's very doable. Um, and my gold, long held gold target of 3,000, I haven't raised, but I do think that's going to prove probably conservative. So, I'm still there. I think gold has behaved quite well. Silver not so well. It got up to I think 32, and it's backtracked to it was 26 and a half yesterday, I think. So, um, but again, it moved up from the low 20s, 21, 22, up to 32, and this is a step back. Part of that, what I keep calling a stair step process in markets. And so I think the problem is you had this huge run in the first decade of this century. So from 2001 to 2011, you had a huge run in both gold and silver. And, you would expect a couple year consolidation of that because it was a huge run, maybe two or three. It's been fits and starts since then. Now gold's gone on to new all-time highs, but silver's far below the highs back then. It's had some years where it's done well. Both of them did well coming out of the pandemic lows. They ran from April to August were dramatic runs in both gold and silver and the miners. But then since then it's been really erratic. I will tell you that in 2020 in 2022, if you look back at the charts in the first 4 months of 2022, it looked like you were off to the races and it was finally going to be their day. I guess it probably the first quarter, maybe not even April. And then Russia invaded Ukraine, and the dollar took off, and we had a huge run in the dollar over the next 6 months. And that bull run in the dollar killed the the gold, silver, and the miners. And so over the next 6 months, they took gas. They got hit hard. They came out of that in September, October of 2022, and that was the bottom of the cycle for gold and silver. And it's been kind of a process since then. Like I said, gold's done pretty well. Silver woke up this year, and this is a setback, but it's still the bull market's intact. And the miners have been the real disappointment. They've just taken their sweet time, and this quarter, the numbers coming out of some of the miners have been dreadful. And people are going, how can you have the kind of run we've had in the metals, and then they don't report good earnings? They disappoint. They're off by a lot. And I think you can answer that in a few ways. One, managements, I think, in the silver and gold mining area are not the best. They get, I think they are getting better, and they are focusing less on their own pockets and less on exploration, further things down the road, and trying to rationalize, trying to get their operations running better. But it's a tough industry because they're operating in tough environments politically, sometimes, environmentally. There's always somebody trying to take a piece of their business. The governments want to tax them like crazy, etc. So you've got all that. I do think the managements are getting better, but I think what's happened here is you don't, the prices are moving up, and they are getting better prices for their products, but costs are moving up too, and also, some of the price movement hasn't been realized yet in what they sell. People think it's not spot price. They're not getting the price. They've got contracts, etc. So, what I will say is, if I'm anywhere near right on my targets on gold and silver, you're going to have they can still not be great at realizing the gains, the benefits of those price moves. But you can drive a truck through the benefit. In other words, it's going to be a large enough move that even companies that aren't really getting all the benefit will do well. So you can't. If silver more than doubles, they're going to have a windfall there in terms of their abilities to produce earnings. So I would tell investors, don't get too discouraged with short term quarterly earnings. I think there's better days right ahead. Um, and in terms of the metals themselves, like I said, 75 would be a huge run, but I think it can really happen. Technically, it looks to me like it can happen. And my guess is, as I tell people, it's not necessarily tied to the stock market timing. So you could have the stock market top out months before the metals. The metals might run into the early stage of the bust, and be seen as a safe haven, or the bust might take a little longer, and it could push the metals into, I kind of say they can spill certainly into the first quarter next year. So I'm not saying that you're going to get this move from 27 on silver to 75 in 3 months. It might take 6 or 8, or it might happen in 6 or 5 or something like that. So, I do think it's coming. And I'm trying to think. The other thing to realize is that there is, following all of this, a bust and a bear market. So in the bust, I think almost all assets will come down, which will include the metals and the miners. As much as I have a huge bullish call for the next cycle in the metals, it's buy and hold may be tough. If let's say gold goes to 3,000 or 3,200, something like that. In the bust, you might see gold back to 2,000, 2,200. Just be aware that it's going to be volatile on the downside in the bust. In silver, more so. If silver goes to 75, it could correct 50% or more in the bust. I'm not sure where it would come back to. It might come back to here. It might come back to 35 or 40, but it will have, I think it's a more cyclically sensitive metal. Gold has other properties, but so silver will be more volatile on the downside, as it always is. The miners even more so. So in other words, don't marry these things and think that they can go straight in one direction. And once they get going, because I think, as I say, it's like standing on the south rim of the Grand Canyon, looking across to the north rim, and thinking you can walk straight across. There's this canyon in between that you want to be aware of, and then once we get through the bust, I think the metals will be, if not the most, the highest performing assets, very close to it. So I have a forecast of 20,000 on gold for the end of the decade or early next decade, and a forecast of 500 on silver. So you can see, it's not going to go from 75 to 500, but it could go from, let's say, 40 or 50 in a bust, or 30 or 40 in the bust, to 500. That'll be a hell of a run.
Yeah, those would be very volatile moves to see in a market that has pretty much stayed out of the media for the most part. It just hasn't been very exciting. I think it's why people have kind of ignored it. But
yeah, I would just say go back and look at 2001 to 2011, and I think you'll get the sense that these things can have those kind of time periods. It's just been a long time since we've had one.
Yeah, exactly. Moving on to the bust, I want to touch on this as well, because it's important for people to keep in mind that just with these amazing targets you have, if we do see them, the crowd is definitely going to be extremely bullish at that point. They're going to be saying that it's a multi-year bull market ahead of them. And I'm curious, do you see it as more economic deceleration eventually, catching up, being evident, and then people realize that, oh, we've been in a recession for a few months now, and then that finally triggers the bust? Does the Fed tighten again because they see the markets at these extreme highs?
Yeah, it's
What do you see
impossible
as
to
the
know what.
triggers?
Yeah, it's impossible to know at this point what will trigger it exactly. Um, I'm not so worried about the catalyst because what you could have is the market basically in this buying stampede or in this melt up into a top, just burning itself out from, if you go vertical at some point, it just all of a sudden, just like what we saw in a kind of a microcosm of it in July, is it just reached a point where it was starting to roll over, and then something else came along that took it down lower. So it can start out looking like a plain ordinary, pullback after a run, and then all of a sudden some other things come along to pile on it, and the next thing you know, you're breaking trend lines, and the technicians all start running for the hills, telling you it's heading lower, and then more people jump on the negative bandwagon. And I wouldn't be surprised if let's say my numbers, if I get anywhere close to my targets in terms of preciseness, I'll be surprised. I mean, it could be that it gets to 6,800, or it could be that it gets to 7,800. I don't know. 7,000 is my best guess for the S&P, but it doesn't mean it's 7,000 and straight down. So let's say we'll use 7,000. You could have a move down where you're down 10 or 20% in a matter of a week or two or three, and then bounce back from that. So let's say you go from 7,000 to 5,600 or 5,500, and then you rally back above 6,000, and then you go down a lot more. It could be anything like that, or you might even see the first step down being 30, 40, 50%, and then having a multi-month long rally that takes you back half or 2/3 of the way back to the top before you go down. So it's not like as soon as you hit a top, it's straight down to the bottom. There's going to be counter trend rallies that'll be pretty sizable, I think, along the way. The catalyst can be the Fed could zig when they should have zagged. They may just continue behind the curve, or they might tighten because they think markets are yes, too frothy, and so they say, well, let's take a little bit off the table here. And it's not just rates; it's money. They can pull money out of the system, or they might, do reverse repos, those kind of things, or they just may not ease fast enough. As I say, this is probably the most likely. Is that let's say they start the easing cycle in September, and with rates, and maybe they hold off on money, which puts them even further behind because money is more important than rates, in my opinion. But so let's say they continue to shrink the balance sheet a little bit. They lessen their shrinking, but they're still not putting new money in. Let's say they do that, and they wait 3-6 months too long to really understand how bad things are, because as I don't know what the exact saying is, but things happen slowly until they happen all at once, right? So you can all of a sudden have, and it might be a crisis overseas. It might not be here. You might have a banking crisis in Europe, or things falling apart somewhere else where they have to get in. It's going to be hard. If I'm right that the bust is going to require 20 trillion, or is going to see 20 trillion in new money from the Fed, and proportionally that kind of new money from all central banks, not they all do less than the Fed, but they proportionally something similar. If I'm right that it's going to be anything of that magnitude, we had in 2008, October 2008, when all hell broke loose. The Fed's balance sheet was 875 billion. That was the high watermark going back to 1913 for the Fed's balance sheet. Never been higher than that. All of a sudden, because of what happened with Lehman and AIG and so many other things at that time, all the banks were going towards zero. You saw the balance sheet expand by well over $1 trillion. I can't remember, the first jump might have been 1.6 trillion or whatever. But and then we had QE1, QE2, QE3 over the ensuing next several years. So that when we got to 2020, the balance sheet was, if I remember right, was 3.5 trillion maybe. and we we expanded the balance sheet in 2020 and 21 up to 9 trillion, right? So you had a 5 trillion expansion in a matter of 2 years. We went from 875 for being what it was for over a century or almost a century to 875 billion to where now all of a sudden we're 9 trillion. And we did it in a few big steps. So you can imagine, let's say I'm right about that 20 trillion being in, instead of 5 trillion, now it's multiplying because of what's happening in the super cycle, it's multiplying where you need so much more than 5 trillion. They're not going to go, oh, yeah, let's just throw 20 trillion there. It's going to come in steps. And don't forget the Fed, Powell's been very vocal about not going back there again. Everybody thinks it was a mistake to do zero rates for so long and to print money at that rate. It probably was, but so he's pretty convinced that we'll never go back there. In fact, he's been on record as saying we're not going to do QE again. So they're going to be reluctant when the time is desperate for new money. That's the only thing that can save a free falling system. They're going to be reluctant to be doing the magnet. They'll be reluctant to do any, but then when they start doing it, which they will, they're going to be really reserved in terms of what they think is the appropriate amount. They'll think $1 trillion is, oh, we're going back there. We may not want to do this, but things are looking bad. We'll do it. And then they're going to do, and that's not going to do it. So they're going to go a couple trillion. That's not going to get to 20 trillion is not going to happen in 1 or 2 steps. It's going to take them a while. And so it's not only because people think that you can have a bear market that instantly turns around because the Fed realizes they have to do something, and then you start a bull market again. That's not how it works, because they've got to get to a right-sized policy to turn things around. Just the fact that they're starting easing is not right-sized. They can be behind the curve for a long time thinking they're getting ahead of it. Why? Because the nature of this next unwind is beyond anything that we've ever experienced. That's why I call it the biggest financial crisis in history. Probably 2008-9 was probably the biggest one in history because of the, not as big in terms of the pain and suffering caused in the Great Depression, but because we're a so much bigger system now, it was bigger. And we've blown it up even that much more. Debt and derivatives are so far beyond anything we saw in 2008-9 now. So when that unwind happens, they just don't have the mindset to understand how fast and how big that unwind can become, can get, and I think it's going to take them. Again, they're a committee by consensus. Powell, I defend Powell on lots of things because I think he's been very sincere and very transparent in what he's doing, and I think they're logically trying to do this thing and do it in a diligent way. Not, they're not going to move around like traders do. Traders get upset when they don't do things on a dime. They're trying to be diligent. They're trying, and it's going to be something they think if we tweak it here and tweak it there, and each time look at things and move in the right direction, we're doing our job. So I don't blame him for that. It's the nature of the institution and what they're tasked with. But because they don't have market experience, they're going to be, I think, shocked at how fast markets will be discounting things, and how fast and big moves can be, and how they've got a ball and chain on them right now because they're living in the last cycle where the Fed got criticized tremendously for overdoing it on the ease side, for overdoing it with QE and interest rates, and staying down at zero, at zero interest rate policy for so long. That's what's foremost in their mind is we're not going back there. We're not going to do that. I have a forecast that calls for that says we're going to see a 0%, if not negative, 10-year next year in the depths of the bust, and short rates negative. If you ask Powell today if that was possible, he'd say it's impossible. We'll never do that. He has no idea what's coming. And I don't blame him. This is history. We're at the end of we're coming to the end of a 80 plus year super cycle. And at that point, every cycle's gotten bigger and more volatile as we've gone along, coming out of the Great Depression, and then every successive cycle. I've been doing it since '73, and certainly is true. And each cycle required more Fed input, more money, more policy aggression than the last cycle, because the excesses got bigger each cycle and led to bigger downturns or bigger problems. So we're now at the point where that just explodes. And 2008-9 was that almost, but this time like I said, leverage is so much bigger today than it was then, that it's going to be so much bigger than that. And that means the volatility is so much bigger. These are human beings that have learned their craft in academics or in private, in Paul's case, in the private markets. They're not accustomed to what I think is coming. Frankly, Wall Street's not accustomed to what's coming, because this has never been seen before, the degree to which we're going to see the volatility, I think. So, but if they had, a couple of people on there, like me, who grew up in the financial markets, it would help, but they don't.
Okay, so they should have some more people like you on the FOMC.
Yeah, I'm not saying me, but there are people, and there are lots of people in the market that I wouldn't think would be helpful. You need somebody who understands the full history and understands monetary policy, but also understands the markets. Bernanke was very good in terms of understanding history and understanding the monetary policy. He just didn't have the financial market wherewithal either. So he came closer than Powell. Powell's a good guy. I mean, very bright guy. Like I said, I think he's a very sincere, honest guy. It's funny he gets beat up for being some kind of a charlatan, or doing things to hurt people. Or he's not at all. He's really, I think, a very quality person. It's the cycle we're in.
And it's difficult for them to recognize that. And I'd love maybe in the future to hear more, once we get to maybe the peak of the market, to hear what your thoughts are after the bust. I know you talk about commodity super cycle basically being a main driver behind the coming cycle. And maybe just for the viewers, it could be helpful to just hear some generic, not specific advice from you, because I know you mainly emphasize just the importance of getting one's financial house in order for what's coming. Just seems like most people are going to be caught off guard with what ends up happening in the bust and in the very inflation driven and commodity super cycle after that. So what might somebody do to best, I don't want to say prepare, because that kind of implies some sort of other maybe things that people would do, but what might people do to best position themselves for what's coming?
Yeah, I'm going to take your question. I'm going to turn it around a little bit and say, because I have said in many interviews, the best you can do is get your financial house in order between now and the collapse that I see coming in the 2030s. This, again, the reason there's a recovery cycle following the bust is because of the printing press. I believe the bust will be deflationary, which means the Fed and the other central banks will have almost infinite ability to print money. So, because the inflation won't show up for a couple of years, at least not big inflation. So that means you have one more chance to blow this thing up to a even bigger problem. The end of this decade is that huge money I was talking about, the 20 trillion plus, everything, the other central banks are doing, that's going to lead to worldwide inflation like we haven't seen since the early 80s, and it'll go beyond that. I think I'm predicting, again, it's seat of the pants, but I wouldn't be surprised to see 25% inflation here in the US by late this decade, early next. So if we get that, that means interest rates go up there too. So you'll be looking at 20% type interest rates. There's no way we can fund our government. I mean, we've blown up the balance sheet. We've got a government debt that we can't handle now at 5%. They're not going to be able to handle it at 10%. Imagine what it's going to be when it gets to 15 or 20% to service that debt. It's going to collapse the system. And again, I'm focused on the U.S., but it's around the world. So I think we're going to have a systemic collapse of governments around the world and financial system around the world in sometime in the 2030s, probably sometime in the first half of the 2030s. That doesn't mean 2030. More likely, it's 2033, 4, or 5, somewhere in there. I don't know. We'll have plenty of time to sort that out as we get there. There'll be warnings. But the point is that I don't have any particular advice that can tell you how you're going to survive that, because it's number one, it's out there. I don't want people losing sleep over it. But the best you can do is use what I think is going to be the balance of this decade to get your financial house in order. And number one way is to get yourself out of debt, obviously, or work yourself out of debt, or more importantly, don't get yourself overextended. The second thing is, and from a market standpoint, just looking at this last week and seeing what I get on Twitter, and and what I see elsewhere on Twitter, not even my followers, do not get so micro. Don't try to micromanage your accounts and get caught up in the emotions of short-term moves. I mean, I have people on my, one guy in particular who, once the charts start going his way, he gets crazy and thinks, he's got the perfect understanding where we're going and it's straight down. Maybe he'll be proven right, but I think he's caught up in the emotion of the charts. And it might, there's probabilities in this business. If you get too caught up in thinking short term is, what everybody's saying short term and what everybody's reacting to short term is how you're going to invest, I guarantee you're not going to get your financial house in order. Take a more diligent, calmer approach to things. Doesn't mean you're going to miss corrections. Doesn't mean you're going to win all the time. But if you're in good investments and you don't panic, there's opportunities. And again, there's some big things to pay attention to. One is the Meltup. It's going to be a big return in a short time, I think. But then there's the bust. That's going to be huge losses in a short time, over the course of 6 or 9 months. So if you can avoid those, then that sets you up for the next cycle. And in the next cycle, it is a commodity super cycle. I think commodities will be the leaders, just like tech were the leaders in this cycle. You're going to see commodities, they'll start gradually and then they'll just start going steeper and steeper. Using my gold prediction, gold might start at 2,000 or 22 or 300 or 2,500. And by the end of the decade or early next decade, be 20,000. That's, 9 or 10-fold increase maybe in something. If you do it right, that can set you up. If you do it wrong, where you think you can constantly be trading and reacting to other people's, constant people's views day to day and week to week, you're going to get to the end of the decade and go, how did I miss that opportunity? I hardly made any money in gold because I got out at the wrong times and missed the moves. And, so it's, I'm kind of just giving an example of how basically being a little bit more systematic, less less trading oriented might help people. I'm not here to give investment advice. There are lots of ways to make money in markets. So I'm just, for most retail people, the mistake I see made so often is they get too caught up in the tape and too caught up in the emotions of short term. So that's really what that message is.
Yeah, thank you so much for just laying that out. I feel like social media and just the constant news cycle has made it very unhelpful for people to have a long-term perspective when it comes to their investments, and just the
I
importance of people seeing the long term, and also, the importance of not overextending yourself in a specific trade, not being dependent on something happening a specific way. um, I'd love, David, for you to share, where my subscribers can find you. I know on Twitter at Dave H. Contrarian, and you also have a letter by paid subscription, Contrarian Value Advisor. Just let people know where they can find you.
Sure. Yeah, I'm on pretty much every day. It's funny. I get people. I had somebody this morning criticizing me, saying, "Well, he hasn't been around to talk about what's happened in the last few days because the market sort of went against my call." So he's criticizing me, not in a nice way, saying, "Well, where's this guy? He's not out there defending this position." And I said, I probably posted 100 times in the last 3 days on Twitter. Your settings on your Twitter account are not right. You're only seeing when I initiate a tweet. You're not seeing the many replies. So I'm on Twitter every day, most every day, responding to questions. And I'm not going to respond to every question. There are a lot of people with repetitive questions and questions about day-to-day trading and things like that. And if I ignore you, it's typically because I either answered that question too many times already, or it's a question I don't think is relevant to what I'm doing. So, but I'm on there, and as you say, I write a quarterly macro letter. If people are interested, DM me on Twitter, direct message me on Twitter, and I will respond with a explanation of what's in the letter, kind of brief idea of what's in the letter and cost, and if you decide then you want to subscribe, I'll provide you information for that. So
Yeah, David Hunter, everybody. David, thank you for coming on again. I'll put the link to your Twitter in the description below. I really appreciate you coming on, sharing your thoughts with us.
sure, glad to be on, and enjoy your time in Hawaii.